Rich Lowe, Pilot Legacy, on site at the Stanton, Lockhart, Texas, with our March 2023 investor update. Recall that when we released last month's update on February 28th, we had just completed the Phase 2 carve-out from Phase 1, thereby permitting Phase 2 of the Stanton to proceed. Shortly after closing the Phase 2 carve-out, Encore Bank locked in the terms for our Phase 2 construction loan, and we contemplated closing on that loan immediately. Why consider closing the Phase 2 loan first? At the time, we were waiting on Arbor to complete their administrative checklist following the Phase 2 carve-out, which was necessary before we could lock in the terms for the Phase 1 refi. And we simply didn't know how long it would take. Well, on March 2nd, just 2 days after I posted the February update, Arbor notified us their checklist was complete and they were ready to lock in our Phase 1 refi terms. Now, at the time of shooting the February update, we were all anxiously watching the 10-year Treasury rate as it had been rising unabated since Arbor first issued its initial term sheet on January 18th. And although rates had just broken through an area of technical resistance on February 21st, we did notice some consolidation starting to occur in the yields in the days to follow, leading us to believe a downward move was imminent. We very much wanted to see the rate revisit where it was just a month earlier. However, on March 1st, the 10-year made a big move upward from 3.9 to 4%. And then on March 2nd, it climbed even higher, approaching 4.1%, when we got the call from Arbor and they said it was ready to lock, and with $300,000 in additional loan proceeds to boot, taking us from 15.9 up to 16.2 million. The news of the additional loan proceeds was fantastic, though we were really hoping for rates to move back lower before we locked. Well, after much discussion and analysis, we decided that locking on the spot was by far the most responsible thing to do. With so much rhetoric from the Fed governors about entrenched inflation and the need for additional rate hikes, the risk of rising interest rates and additional cuts in loan proceeds was very real. So we took the shot and locked the rate and put the Stanton Phase 1 in a healthy place. So I'm happy to report on March 2nd, we secured a 10-year fixed rate Fannie Mae non-recourse loan at 5.93% with 5 years of interest only and a 35-year amortization kicking in at year 6 should we need it. This gives us a monthly debt service of $80,000, a 35% reduction from what we had been paying on the Phase 1 variable rate loan just before the carve-out. This is a vast improvement and eliminates the single greatest risk factor we were facing at the Stanton, a relentlessly rising debt service that was getting dangerously close to the debt service coverage ratio limit on our variable rate loan. Emergency terminated. Well, wouldn't you know it, in the days following our rate lock, the 10-year rates began to plummet. But this was due to growing indications of impending liquidity shortfalls in the financial system. Isn't it funny how the bond market seems to always sniff these things out before they actually happen? And on Friday, March 10th, as you all may have heard, Silicon Valley Bank in Santa Clara, California failed. And by the following Sunday night, regulators moved in to shut down Signature Bank to prevent a wider banking crisis. The bond market continued to react accordingly, reflecting the sentiment that rate hikes may have gone too far. Looking at the 10-year chart, though it may look like we just missed the boat on the downward move in interest rates, lenders increased the risk premiums they apply to the 10-year rate because of the now greater liquidity risks in the financial system overall. In fact, according to Arbor, in the immediate wake of the SVB and Signature Bank news, the bids on Fannie Mae Commercial paper dried up overnight. There was nothing moving, and we may not have even been able to lock a refi rate at all had we waited. And even if we had waited and were able to lock, though the 10-year rates were much lower, we would have received a more expensive lending rate overall due to the risk premiums increasing more than the bond yields themselves decreased. So we look at our decision to lock before the bank failures as a win. Keep in mind, Fannie Mae is the Stanton's biggest investor. Fannie Mae repackages commercial loans such as ours and sells them on the securities market as income-producing instruments that satisfy the most stringent standards of quality and reliability. Fannie Mae's payments on these securities are not guaranteed by the U.S. government. Thus, it's important that Fannie Mae uses strict underwriting standards to evaluate the credit quality of the loans it guarantees, thereby minimizing the risk of loss to its investors. While Standard & Poor's, Fitch, and Moody's don't rate mortgage-backed securities issued by Fannie Mae, securities collateralized by Fannie Mae and issued by other entities are consistently rated as AAA. That is to say, Fannie Mae loans and the collateral they represent are issued only to the highest quality and most reliably producing commercial properties. Before issuing the Stanton's Phase 1 refinancing loan, Arbor, which is a delegated underwriting and servicing loan provider for Fannie Mae, brought in a team to conduct an audit of every aspect of the Stanton. We passed that audit and inspection with flying colors in what constitutes one of, if not the toughest, lending standard in existence. This ought to make you feel pretty good about the health and prospects of the Stanton project overall. Now, as for the Phase 2 construction loan, despite the banking turbulence and the Federal Reserve's interest rate hike last week, which brought the federal funds rate up to 4 3/4 to 5%, our loan proceeds with Encore Bank remain unchanged and locked at $17.3 million. With all the traditional risk factors associated with the commercial development now mitigated, and with all the financing locked with a fixed rate and building permits in place, the additional capital we required has been pouring into the Stanton as additional savvy investors like yourself recognize the Stanton constitutes a hard asset and a safe harbor for capital in a stubbornly inflationary environment. Closing of the Phase 2 construction loan is less than a week away, scheduled for April 4th, with groundbreaking to commence in the days to follow. Our first owners, architects, and contractors meeting is scheduled to take place on site at the Stanton on April 20th. Meanwhile, we continue to upgrade amenities on site. Here you can see crews are installing a pagoda over the mailboxes, and work continues to the east on the 2 single-family developments underway, as well as on Lockhart Farms next door, the 120-unit Litech property coming online in the months ahead and being built by our general contractor, Axia Construction. And just to the west of the Stanton, a senior living community is also well underway. And then here you can see to the north, work continues on the regional joint-use stormwater detention pond the Stanton will be sharing with our neighbors. Over the past year, we've encountered both timing and financial obstacles nearly nonstop. The fact that we have been able to raise the amount of capital that we have despite these many challenges is a testament to your confidence in the project, the market, and our team. We're humbled by your trust and excited about the impending execution of Phase 2, as well as the developments popping up all around the Stanton and Lockhart and all along the State Highway 130 corridor. So it's finally time to execute, and let's get this train moving.